Welcome to Plus TV. Today we have Judith Sciamma, CEO of WyeTree Asset Management, a London-based asset manager that focuses on the residential mortgage backed securities market. And she's here to give us an update on what's going on in the RMBS market globally. Judith, a lot of investors are saying that the European market right now is very similar to the US market about 4 or 5 years ago before the financial crisis. Are you seeing that? And what can you tell us about the RMBS market that investors are unaware of?
It is true that the size of the two markets is fairly similar, but I would say that it is about it. In America, you have $1 trillion of US RMBS left in the non-agency market. In Europe, you have about €1 trillion of European RMBS, but there is a key difference between those two markets. In America, we are speaking about non-agency, which involves subprime people. In Europe, you need to know that most of it is prime. There is very little subprime issuance, except in the UK. And even in the UK, this is not subprime per se, like for like with America. It's more non-conforming, which would be something in between subprime and Alt-A. So that's very different, because when you speak about European RMBS, you should have in mind that this is about mostly prime people. And when you say prime people, it also means that the delinquency numbers that you get in the main deals is about between 1% and 2% and 17% for UK non-conforming, whilst the same number in US non-agency RMBS would be something around 25 to 30%. So you see, even though both markets are very distressed, and in both areas house prices have been dropping, even though not homogeneously across Europe, by the way, the similarity is not that straightforward. In terms of data, in America, we are very used to seeing low-level data, granularity, access to history. In Europe, it is not that straightforward. For example, in the UK non-conforming data market, you will have data available. You can find some good history if you look for it, but it's not true across all the countries and on all the deals. So effectively in Europe, I would say it's a lot more hands-on market, and you have really to look for data, dislocation, differences, and information on the deals. In terms also of structure, in America, you will have a structure with a lot of tranches, and the structure itself can be very tricky, and you could find, for example, a very distressed collateral with a very good structure on top, and the combination of those two would generate value, and you have to capture the value of this investment. In Europe, the structure of RMBS bonds seem to be a lot simpler, a lot more straightforward, even though there are some trickiness also with some turbo features sometimes, or some triggers which could pass. But the structure is simpler. It is the collateral that you have to analyze very deeply, because the structure, it will be much more straightforward. So all this means that finally, in America and in Europe, you have dislocated markets. House prices have dropped post-crisis, but the reactions and the speed of actions taken by government has not been the same. And in fact, if there is a recovery, it will not come from the same place.
So why would you focus on Europe right now?
It was only in 2011 that the EFSM was created, European Financial Stabilization Mechanism, and in the late 11, that is December 11, that the LTRO was put in action, long-term refinancing operation. So effectively, 4 years after the start of the crisis. So now, like in 2013, we can look back a little bit and see action plans which have been put in place, austerity measures which have been implemented through various countries, Ireland, Greece, Spain, even France, Italy, the Netherlands. And I believe that at some point this will deliver result. In Europe also, the cultural habits are very strong, and you cannot necessarily take for granted what you know about the American market to decline the concept on Europe. So for example, in the US, when people change job, they may have to be a forced seller of the house because effectively the new job they just found was at the other end of the country. If you take a country like the Netherlands, you are about 1 hour away from one end to the other side of the country. So someone who would find a job at the exact opposite of the country would not be a forced seller because it would take him about 1 hour to get to his new job. This is, for example, a very strong difference. In terms of recourse, in the US, very often it is not full recourse or very low recourse laws. Across Europe, you have very strong recourse laws, and that has a direct impact on borrowers' behavior. So, for example, if you look at the statistics in the UK, more than half of the people who are 90 plus delinquent will try hard to pay something and to pay some form of arrears, which means that you can see some deals where even though people are delinquent, the servicer, I'm speaking about the UK non-conforming market, will still manage to collect 98% of what he was originally expecting. Maybe not the same way as he would have expected, maybe not from the same people who were supposed to pay this month, but definitely from those who are trying to catch up with those arrears. This is not a phenomenon that you tend to see in America, where when people are 90 plus delinquent, 60% of them will pay actually nothing. This is due to the strong recourse laws that you have across Europe. So when investing in Europe, you have to be very careful about the local habits and what will drive people to pay or not to pay for their mortgage.
You mentioned a mosaic in Europe. Can you dig a little bit deeper on all these different opportunities, all these different countries, and where the dislocations are in these different specific countries?
Let's speak about, for example, house prices. It has been diverse across all Europe. If you take Portugal, since 2000, there was never really a bubble because it went up as high as, for example, 25%, which is really not much. Whilst over the same period, the UK more than doubled up. It went as high as plus 140%, which is a lot. In Spain, Spain and Ireland actually followed a similar pattern as the UK and went up very high. But from the peak, again, it's different by countries. UK has lost from the peak to now about 10%, whilst Ireland would have lost 50%. And Spain is in the middle, 30%. So you can see that even in a similar bubble pattern, the consolidation has not been the same. In terms of unemployment also, it is not homogeneous across Europe. You would have a very high unemployment level in Spain with 25% and fairly low in the UK and the Netherlands with about 7%. So again, it's a country by country story where macroeconomic data do matter, because if you look at the performance of the collateral, which is what matters to us, that will be influenced by macroeconomic data, for instance.
So what does the future landscape look like in the short term and medium short term in Europe?
This is a difficult question because the signals we receive are a bit foggy. For example, let's take Spain. Numbers released last week were fairly encouraging, with retail sales increasing for the first time and effectively GDP improving. But numbers we had this week on Italy whereas the opposite, with a very high unemployment, especially among the young population, a GDP decreasing, with an economy still showing signs of shrinking. So where does this take us? I'm not sure over the short term, but what I think is a positive is that we can see a lot of agitation going on, lots of plans being put together, with the ECB being very supportive in terms of help, interest rate, governments trying to implement measures as well. So I think that over the medium to long term, we should maybe exit the recession in Europe. I think it's important to do a deep work in terms of each country and take the time to analyze each and every one of the one you're looking at, because effectively each country comes with effectively negatives but positive also embedded in the numbers we see, and that's how you find out value through distressed opportunities.